Listen to me very carefully. Right now, at this exact moment, you are standing in front of a door. On one side of that door is a generational wealth. On the other side is financial oblivion, and the people who control the system are doing everything in their power to make sure you walk through the wrong one. They need you to panic. They need you to sell. And they need you to do it before you realize what they just did to you. Friday, February 13th, 2026. This is the Asian guy. And today we need to talk about the greatest robbery in modern financial history. Not a robbery that happened in the past. A robbery that just completed yesterday. And if you missed what happened in the last 48 hours, if you do not understand the pattern that just carved itself into the price chart, you're about to miss the most explosive move in precious metals history. 2 weeks ago, silver was trading at $122 per ounce, the highest price ever recorded in human history. Gold was above $5,600. The momentum was unstoppable. Central banks were buying. Retail was piling in. The squeeze was real. Everyone who had been waiting for the metals to break out was finally getting validated. The technical indicators were screaming higher. The fundamentals were locked in. The supply deficit was undeniable. And then on January 30th, someone pulled the rug. Not slowly, not gradually, violently. Silver crashed from $106 to $73 in a single trading session. $43 gone in hours. A 36% intraday massacre that wiped out billions in market capitalization before most people even woke up. The first strike, the left shoulder, silver recovered over the next week, climbed back to $84. People started breathing again. Hope returned. The talking heads said the worst was over. And then yesterday, Thursday, February 12th, they executed the second strike, another coordinated dump. Silver crashed from $84 to $73.86 at the intraday low, down over 10% in a single session. The right shoulder, the final shakeout, the last trap designed to break every remaining believer before the launch sequence begins. But here is what makes today different. Here's what separates the people who will build generational wealth from the people who will spend the rest of their lives asking what happened. Today, Friday, February 13th, silver is trading at $77.32, up 213, up 2.83%. Gold is at $541, up 2.45%, 45%. The recovery has begun, and it is not beginning randomly. It is beginning precisely according to the most powerful bullish reversal formation in technical analysis. We are watching an inverse head and shoulders pattern complete itself in real time. And if you do not understand what that means, if you do not understand the mathematical implications of this structure, you need to pay very close attention to what I'm about to show you. Because the measured move target of this pattern is $14 and the breakout is imminent. Let me explain the anatomy of what just formed, because this is not just any technical pattern. This is the single most reliable bullish reversal formation in all of technical analysis. When an inverse head and shoulders forms after a sustained uptrend, when it appears at the right shoulder of a consolidation phase, the breakout success rate is over 75%, and the average measured move is 93% of the calculated target. This is not tea leaves. This is statistical probability backed by decades of price data. Go back to late January and early February. The price found support around $74 after the first selling wave. That was the left shoulder. The bears were aggressive at that point. They were confident. They thought they could break the spine of this market. They threw everything they had at $74. Futures dumps, margin requirement increases, negative media coverage, and the price held. It bounced. It recovered. That bounce created the left shoulder formation. The market was telling you that $74 represented strong institutional buying. Someone was stepping in at that level with size. Then came the head, the panic event. Maximum fear concentrated into 72 hours. The price violated $74. It went into absolute freefall on January 30th. It capitulated all the way down to $64 in a crash that terrified every single leverage trader on the planet. That was the system purge, the algorithm hunting down every stop-loss order, every weak hand, every over-leveraged position that could not handle volatility. It flushed the toilet completely. And here is the critical detail. The recovery from 64 was immediate and violent. It did not grind slowly higher. It exploded. That tells you the selling at 64 was forced liquidation, not genuine price discovery. Real sellers would have created resistance on the way back up, but there was no resistance. It was pure short covering and institutional accumulation. And then what occurred? It rebounded. It did not gently recover. It rocketed vertically back up. It reclaimed $70 in a heartbeat. It reclaimed $80. It pushed to $84. And then yesterday, Thursday, we carved out the right shoulder formation. This is the single most critical component of the entire pattern. For an inverse head and shoulders to trigger properly, the market must pull back one final time. The bears have to test the conviction of the bulls. The sellers have to throw one last punch to see if the buyers will flinch. And yesterday, they threw that punch. They dumped massive volume onto the market. But look at what happened. The intraday low was $73.86. Do you comprehend the significance of that number? 73.86 is higher than 64. It is even marginally higher than the left shoulder at 74. This is a higher low. This is the market screaming at you in mathematical language that the sellers are weaker now than they were 2 weeks ago. 2 weeks ago, they could push the price to 64. Yesterday, they could barely shove it to 73.86. They are exhausted. They are running on fumes. Every time they attempt to slam this market, buyers step in at an elevated price level. The floor is ascending. The neckline of this formation sits precisely between 84 bars and $88. That zone is the trigger mechanism. Once this right shoulder completes its consolidation and the buyers push through that neckline, the technical target is calculated by taking the vertical distance from the head to the neckline and projecting that distance upward from the breakout point. The distance from 64 to 84 is $20. Add $20 to the $84 breakout level. That calculation yields a technical price target of $14. That is where the mathematics of this pattern are pointing. That is the destination encoded in the structure. And today's move, this 2.83% rally to $77, is the beginning of that breakout sequence. The right shoulder held, $74 held. The pattern is valid. The spring is coiled and the energy is about to release. Now let me show you exactly what triggered yesterday's dump, because this was not random. This was not market forces. This was surgical psychological warfare executed with military precision. At 9:14 a.m. Eastern Standard Time on Thursday, a Bloomberg terminal alert appeared. 13 words. Sources say Russia considering partial reversal of dollar ban for select energy trades. 13 words erased 10% of silver's value in 90 minutes. Think about what just occurred. The entire precious metals bull market since 2022 has been built on one foundational reality. The United States weaponized the dollar through sanctions. Russia stopped accepting dollars for energy in April 2022. China started settling oil in yuan. Saudi Arabia let the petrodollar agreement expire. The BRICS nations launched a partial gold-backed settlement system in October 2024. Every single one of those developments removed support for dollar dominance and pushed capital into tangible assets. Gold went from $1,900 to $5,000. Silver went from $24 to $122. Those are not normal bull markets. Those are monetary crisis valuations. But if Russia reverses course, If Putin says we will take dollars again for energy exports, that psychological anchor breaks, the narrative shifts, maybe the dollar survives, maybe de-dollarization was exaggerated, maybe you do not need physical metal because the system is not collapsing. That is what the algorithms calculated at 9:14 a.m. And when high-frequency trading systems that control 73% of COMEX futures volume scan Bloomberg for keywords like Russia, plus dollar, plus reversal, they execute in microsecons. 47,000 contracts sold in the first 15 minutes. That is 235 million ounces of paper silver dumped before most human traders finished reading the article. Except here's the problem with that narrative. And this is where you need to pay very close attention, because this is how psychological operations work. They rely on people not checking the facts. They rely on headlines moving markets before anyone verifies the story. I reviewed actual Russian government statements from the past 6 months, not media summaries, not analyst interpretations, the actual transcripts and official press releases. December 2025, Putin at the BRICS summit in Kazan. The era of dollar dominance is ending. We will construct a multipolar currency system based on bilateral trade agreements and commodity-backed settlement. January 15, 2026, Russian Finance Minister Siluanov at a press conference in Moscow. All energy exports to non-friendly nations will be settled in rubles, yuan, or gold. This policy is irreversible and non-negotiable. February 3, 2026, 11 days ago, the Russian central bank announced in an official statement that they are increasing gold reserves by another 200 tons this year and reducing dollar-denominated assets to less than 5% of total reserves. Do those statements sound like a government preparing to reverse course and resume dollar acceptance? Or do they sound like the precise opposite? They sound like a government that has made a strategic decision to move away from the dollar permanently. The Bloomberg alert said sources familiar with the matter, anonymous, not a Kremlin press release, not Putin standing at a podium making official policy announcements, not even a named government official. Sources in journalism, especially financial journalism, that term has become code for we cannot verify this. But we are running it anyway because it will move markets. It can mean a junior staffer at the Russian finance ministry repeating hallway gossip. It can mean a Western intelligence asset planting disinformation. It can mean a commodities trader with short positions who called a media contact with strategic misinformation to profit from the resulting price movement. And here is how you know it was intentional market manipulation. The rumor appeared at exactly 9:14 a.m. Eastern Standard Time, exactly 60 seconds after the January jobs report was released, showing 130,000 jobs added. The timing was surgical. Release weak economic data that should be bullish for metals, then immediately drop a geopolitical rumor that gives algorithms an excuse to sell. The combination creates maximum confusion and maximum volatility. Traders do not know whether to focus on the weak jobs data or the Russia rumor, so they panic and hit sell on everything. Mission accomplished. This was a planted rumor deployed specifically to engineer a sell-off before the weekend. 2 full days of no trading. 2 days for the narrative to circulate among casual investors who read headlines without analyzing mechanisms. 2 days for weak hands to panic. And while that panic was being manufactured, what were insiders doing? Buying physical at $73, covering short positions at a 10% discount, accumulating inventory before the rumor gets quietly forgotten and price gaps back up, which is exactly what happened today. Silver up 2.83%, the recovery beginning precisely on schedule. Now let me explain why these crashes keep happening. Even though everyone knows there is a shortage because there is a mechanism that most Western investors do not understand. A hidden release valve that allows the system to absorb selling pressure temporarily before physical reality overwhelms the paper market. And that mechanism is located in China. This is the silver seesaw. And understanding how it works is the key to understanding why the price can drop 10% in one day while physical dealers cannot keep metal in stock. You must understand how the Chinese silver market is architecturally designed because it is fundamentally different from Western markets. In the West, we have one price, the spot price. That is it. Whether you're buying from a dealer in New York or a refiner in Switzerland, everyone is anchored to the same COMEX futures price. There is one global price discovery mechanism. In China, there are effectively two parallel markets operating simultaneously. There's the official market operated by the Shanghai Gold Exchange, known as SGE, and there is the unofficial market run by thousands of small-scale recyclers, jewelry shops, and industrial scrap dealers scattered across every province. And the relationship between these two markets, the way they interact and balance against each other, is what determines global equilibrium pricing. This is the seesaw mechanism, and right now, it is working overtime to mask the severity of the physical shortage. When you purchase a standard 1 kilogram bar from the Shanghai Gold Exchange, you are buying a VAT-paid product. China imposes a value-added tax of 13% on precious metals. That means if the spot price is $75, the real cost to extract that bar from the vault is $84.75. Normally, the Shanghai Gold Exchange releases fresh metal from central government stockpiles to maintain market liquidity. When the exchange is open and flowing freely, premiums remain stable. Official supply dominates price discovery. But what happens when the Shanghai Gold Exchange runs completely dry? What happens when, like right now, at this moment, the government starts rationing available metal for strategic defense industries and stops releasing bars to the civilian public? Logically, you would expect the price to detonate. You would expect premiums to spike to 50% over spot, but they have not. Why? Because there exists a tax exemption for small-scale taxpayers in China. If you operate as a small recycler, a family-owned jewelry shop, or scrap dealer, and your monthly sales remain under 100,000 renminbi, which equals approximately 14,000 US, you are VAT exempt. You do not pay the 13% tax. You operate completely outside the tax system. Think about the economic incentive structure this creates. Right now, Shanghai Gold Exchange bars are expensive and difficult to acquire because of government rationing. Beijing has made a strategic decision to prioritize industrial and defense applications over civilian investment demand. The official vaults are being drained to supply semiconductor manufacturers, solar panel production facilities, and military electronic systems. The government is not releasing metal to speculators, but street silver, the old jewelry, the electronic scrap, the industrial waste, the family heirloom sitting in drawers across hundreds of millions of households is sitting dormant in the hands of the civilian population. And because these small dealers are exempt from the tax, they can sell their recycled silver into the market at a discount relative to the official price. They can undercut the Shanghai Gold Exchange by 13% automatically. Think about that competitive advantage. If you are trying to sell a kilogram bar from the exchange at $84.75 because of the VT, but your neighbor can sell recycled silver at $75 with no tax burden, who gets the sale? The recycler wins every time. So when the official window slams shut, the scrap window explodes open. And this is exactly what we have been witnessing during these price dumps. The slam to 73.86 yesterday was not coming from new mining supply entering the market. Global mining output is actually declining. Primary silver production from mines fell 3% year over year in 2025. The scrap is not coming from Western recycling either. Recycling rates in the United States and Europe are negligible because the infrastructure does not exist to recover silver from electronics at scale. This is coming specifically from China from a tsunami of grassroots recycling activity. The Chinese public is seeing prices at $70, $80, $90, and they are liquidating everything they can find. They are stripping silver components out of decommissioned solar panels. They are melting down family heirlooms passed through 3 generations. They are buying old cell phones and computers from neighbors just to extract the silver and sell it. They are flooding the domestic market with tax-free metal that bypasses the official exchange completely. This scrap flood functions as a pressure release valve engineered into the system. It kills premiums temporarily. It creates downward pressure on global spot prices because Chinese dealers are dumping material into the market. It creates the illusion that plenty of silver exists when in reality, the country is consuming its own stored wealth. This is not sustainable supply. This is one-time liquidation of accumulated assets. You can only melt down your grandmother's silverware once. You can only strip the silver out of a solar panel once, and once that material is gone, it is gone forever. Most of it gets consumed immediately by industrial applications and never returns to the market. Beijing loves this mechanism because it allows them to conceal the true magnitude of the shortage from both domestic citizens and international observers. But here is the critical fact. This scrap supply is finite. You can only melt down your grandmother's silverware once. You can only strip components out of decommissioned electronics once. The recycling well is running dry, and when it empties completely, when there is no more scrap left to liquidate, the official exchange will be the only source. And the official exchange has nothing left to sell. That is why these crashes are getting weaker. That is why the right shoulder only dropped to 73.86 instead of 64. That is why today's recovery is beginning so quickly. The ammunition is running out, the scrap flood is diminishing, and physical reality is starting to overwhelm the paper suppression mechanism. Now, let me show you what this means. For the next 72 hours, we are sitting at 77 to 32s. We are watching $74 like a sniper watches a target. That is the critical support level. If 74 holds firm, the inverse head and shoulders pattern remains valid. The breakout sequence continues. We push toward the neckline at $84 to $88. And when we break through that resistance, the measured move takes us to $14. But we must also acknowledge the risk scenario.